Hi, Tony Watson here again at the Burbank Realtors Association. I work for Robert Hall & Associates. For those of you who don't know me, I'm an enrolled agent with Robert Hall out of Glendale. I've been around for about 42 years, preparing taxes within the real estate community. Today's topic was a little bit about a couple things. One in particular was the fiscal cliff and the changes that are coming up here in 2013 or 2014. One thing that high-income earners have to be aware of is that as soon as you hit the $400,000 to $450,000 brackets, in that 35% tax bracket, you will now be subject to an additional 4.6% in federal tax, so up to 39.6%. And for the individuals who heard today's seminar, you have to look at that as a dollar amount, so it's 39.6 cents on every dollar that you're going to make that will go to the federal government in that $400,000 to $450,000 bracket. Now, one other thing that you have to look for also is the phase-in and phase-out rulings for the $200,000 to $250,000 income limitations. For the 3.8% Medicare bill, the Obamacare tax, if your AGI is at $250,000, you will be subject to that 3.8% Medicare tax, which is a tax on all of your net investment income reported on your individual tax return. Now, if your AGI is below $200,000, this 3.8% tax will not kick in on your tax return. It will be, for the $250,000 AGI and above individuals, the 3.8% tax will be tacked on to whatever liability you have and file on that individual tax return come tax time. So there are a few changes for the high-income earners living here in the U.S., especially the individuals working in the real estate industry. Long-term capital gains are going to be up 5% if you are filing in the $400,000 to $450,000 bracket range, and that's up from 15%. So 20% long-term capital gain on dividends, qualified dividends, and also long-term capital gains for stock sales or on investment property sales. One part of the extensions of the fiscal cliff happened to be the Mortgage Debt Relief Act of 2007. That was extended for another year, but only till the end of 2013. So if you have a client, friend, neighbor, anybody who is going through that particular scenario, by the end of 2013, that short sale or foreclosure has to be final in order to exclude the cancellation of debt from your tax return. And that could save your clients or friends or family members hundreds of thousands of dollars in tax, depending on the size of the cancellation of debt. So make sure that you're not sending them to Google for the answers. Make sure that you let them know to talk to their tax accountant, their EA, their CPA, their tax attorney, to make sure that they can plan for those things. So once again, thank you for having me today, and I'll see you guys soon.